Good morning, everybody. It's Wednesday, July 31st, 5:25 a.m. Central Time. Grain markets are mixed this morning. December corn futures down a half cent at 404 and a half. November soybeans up 7.5 at 1028 and three quarters. December Chicago wheat down 3 3/4 at 545 and a quarter. December Kansas City wheat down 5 1/4 at 561. December spring wheat down 3.5 at 599 and three quarters. Let's start off with the soybean sell-off.
Soybean futures fell to their lowest level since October of 2020 on Tuesday. The nearby August 24 contract traded as low as 10.24 per bushel. The contract has lost nearly 89 cents during the last three sessions. A less threatening U.S. weather forecast has been primarily responsible for the selling pressure. Many traders are beginning to work with the idea of an above-trend U.S. national soybean yield based on crop ratings and weather. Many traders also believe that the USDA is overstating new crop export demand, given the worst book of sales in 20 years.
Spot month soybean futures, the August contract fell to a low of 10.24 yesterday. The upper end of the U.S.-China trade war range, if you want to call it that, was about 9.50. So you're within 75 cents of being back into the trade war range that we saw in 2018, 2019, and into 2020. That's not a good place to be. Not so coincidentally, the book of new crop export sales is very poor, and it's almost exactly where it was at this point in 2019. So you've got two big factors, and there's a supply factor and there's a demand factor. The supply factor is that we've got a big crop coming in all likelihood. How big is it? Is the yield 50? Is it 51? Is it 52? Is it 55? I don't know what the yield is, but the trade seems to be optimistic. And then on the demand side, you've got to make the argument that USDA is overstating new crop exports. They're looking for a big improvement where I think any improvement would be a victory at this point. Honestly, it's tough to say. That being said, this is a time of year, late July into August, where you would typically see an uptick in new crop export sales. And we hope that that's what we see, because we don't want to get back into trade war type pricing. We're not that far away.
Cooler temperatures are slated to arrive in the U.S. Corn Belt this weekend. Temperatures are likely to run above normal during the next 3 to 4 days prior to the emergence of a cool front in northern sections of the region by Sunday. Mostly normal temperatures are slated to be widespread across the Corn Belt by the middle of next week. The 10 to 15-day forecast involves drastically cooler temperatures for some areas of the central Corn Belt. Rainfall over the last 3 days has been confined to a wide band that includes parts of Iowa, Illinois, Indiana, Kentucky, and Tennessee. The forecast involves more rain for many of these same areas, in addition to Ohio and the far eastern areas of the Corn Belt.
It looks like there is a solid end in sight to the above normal temperature type thing. And even though the temperatures will be above normal for the next few days, it's not extreme. It's not extreme. Go back to last Wednesday and Thursday, and it looked like there was going to be extreme heat in the Western Corn Belt during the first week of August. And that idea has just been totally tossed out the window. And that is largely responsible, again, for the big sell-off in the soybean market. Rainfall is certainly not everywhere, but it's considered to be adequate, especially given the soil moisture situation. I know it's not ideal everywhere, and the forecast is not perfect, but it's wet enough to send soybean prices sharply lower.
So if you guys have not checked out our premium content, you sure need to do so. You will not find content like this anywhere else. Joe, can you tell me about yesterday's premium video?
800 million bushel soybean carryout. This is not my prediction. This is my opinion of the market's opinion. I think this is what the trade believes is headed our way. 800 million bushels in the United States at the end of August next year. If the yield's a little bit higher and the exports are a little bit lower, you can get there really quickly. So yesterday I ran a balance sheet review, and I said, guys, these are not my predictions, but this is what I think the market's working with. This is why I think the board is approaching trade war type levels. Now, honestly, the market's goal right now is to generate demand so that we don't run into this sort of situation. But what USDA prints and what the trade thinks are two different things. Most often, and I think the trade is actually much more pessimistic about this situation than anything that USDA has written on their government paper. If you guys want to see that video, in addition to all of our premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. You'll get our morning email every single business day at 5 a.m. Central Time. We have a new premium video every single business day. All of my cash grain marketing recommendations are included in this. I list every sale that I've advised for corn, soybeans, and wheat broken down by crop year, and percentage. They're all at the bottom of our email every single business day. Give that deal a shot today, guys. I'll forward you a copy of this morning's email.
ADM's profits tumbled during the second quarter. Earnings during the quarter declined by 46% compared to last year, its lowest second quarter earnings since 2020. ADM's profits eroded due to abundant grain supplies, which have suppressed prices. Profits have also suffered because of reduced crush margins. Large crops in Brazil and Argentina have shifted export demand to South America, limiting trading opportunities for ADM in North America. Reduced farmer sales in Brazil and an increase in logistical expenses have also had an impact on ADM's earnings.
You pull up an ADM chart. This almost looks like a corn chart or a soybean chart, generally speaking, in that we rallied out of COVID. We saw some really high prices during 2021 and 2022. And then when corn prices, soybean prices started to decline, the stock started to decline. So I think higher commodity prices are good for the commercials, and the crush margins have declined, and that's a big piece of their market. So yeah, the commercials are along for the ride in this deal to some extent. ADM will be just fine, but you could see some further pressure here, I suppose.
BP's second quarter profits exceeded expectations. The oil giant reported a net profit of $2.8 billion for the quarter, higher than the expectation of $2.6 billion. Additionally, the company increased its dividend by 10%. The decision to increase shareholder returns was based on a strong performance and profit forecast. BP also reported a $1.5 billion reduction in value due to scaling back operations at a refinery in Germany. BP has reduced its climate commitments during the last 2 years and has scaled back on new biofuel projects.
That's the big part, is that last sentence. I know most of you guys don't care what BP stock does, and I don't care either. This is from oilprice.com. In the last 2 years, BP has scaled down its climate commitments, adjusting to an operating model which plans for high oil demand into the 2040s and beyond. Last month, it decided to progress with an investment in a deep water in the Gulf of Mexico, alongside an announcement in which it said it was scaling back on new biofuels projects. And we saw that last month from Bloomberg. This is a separate piece, and this is from BP's website, actually, I believe. BP has scaled back plans for biofuels productions at its Cherry Point refinery in Washington, the United States, and its Lingen plant in Germany. The company won't proceed with plans for standalone biofuel production units at those two facilities, said a spokesman. So BP's backing off a little bit. They think oil is going to be better. I can't help to think that maybe some of this it has to do with U.S. political landscape. Like Trump gets back into office, which looks it's probable. I'm not going to say it's super likely. I know the polls have changed and stuff, but Trump wants to drill, and I don't know if that's good for biofuels necessarily.
The CDC will spend $10 million to limit the spread of bird flu among farm workers. The agency will spend $5 million educating and training poultry and dairy workers on how to protect themselves against the virus, and the remaining $5 million will go towards providing seasonal flu shots for the workers. The seasonal shot doesn't provide protection against the bird flu. However, it may prevent workers from becoming infected with both seasonal and bird flu at the same time, a situation that could lead to flu virus mutations. During the upcoming flu season, the CDC plans to vaccinate all 200,000 livestock workers across the country.
$10 million for the government is like me rubbing two nickels together and saying, here you go. This makes me believe that they're not overly concerned about it. I mean, $10 million when it comes to government spending these days is a drop in a very, very large bucket. So I don't know. I feel like this, I feel like somebody wanted this to be a big story, but I don't know that it's ever going to be. What did cattle do yesterday?
They were narrowly mixed. Feeders were 47 cents lower to 87 cents higher. Live cattle were 2 cents lower to 72 cents higher. Box beef was slightly lower on Tuesday. Choice ended the day at $314.48. That was down 33 cents. And Select ended the day at $301.38. That was down 14 cents.
U.S. dollars lower this morning. Stocks attempting a recovery. The S&P's up 53. Dow's up 150. Bonds are about flat. Gold's up $12. Crude oil is up $1.93, and the September WTI at 76.66. Have a great day, guys. We'll talk to you on Thursday.